There is a data set the Federal Reserve Bank of New York updates every quarter. It sits inside the Bank for International Settlements database. Almost no retail investor has ever opened it. I have read every entry going back to 2010, and what it shows about where we are in the global financial system right now, specifically what it shows about China and silver, is not what you have been told. My name is Ban. I have spent 9 weeks going through the Chinese bond market data, the People's Bank of China reserve disclosures, the World Gold Council quarterly demand reports, the BIS cross-border capital flow database, and the Silver Institute's supply and demand records going back to 2005. I'm going to run the numbers in front of you. No opinions, just what the data shows. And before we are done, I am going to show you the 3 specific thresholds that tell you exactly when the silver breakout ignites, and the 2 instruments that have historically captured the most of what that move produces. Like this video, subscribe to the channel, share it with someone who is watching silver trade sideways and thinks nothing is happening. Because something is happening, and the scoreboard I am about to show you makes it impossible to unsee. Here's the first number, 836. That is the number of tons of silver China imported in March 2026. The 10-year seasonal average for March is 306 tons, 836 versus 306. That is not a seasonal variation. That is not front-running a solar subsidy deadline. That is a population of 1.4 billion people quietly doing what populations do when they can sense a banking system is under stress. They move into physical hard assets. Now here's the thing about that number that almost nobody is discussing. China is the world's largest silver producer. They mine more silver domestically than almost any other country on Earth, and they are still importing 836 tons in a single month. That is the demand scoreboard telling you something that no analyst on mainstream financial television has bothered to explain. I call this the demand destruction scoreboard, because here is what it actually tracks. It tracks the gap between what official economic data says is happening in China and what the bond market, the silver import figures, and the capital flow data say is actually happening. And in every prior instance where that gap opens to the width it is at today, what followed was not a return to normal. What followed was a forced recognition event, where the gap closed not because the official data improved, but because the real underlying data finally broke through. Let me run the scoreboard. Column 1, 2015. Chinese equity market crashed 40% between June and August. The official GDP number for that quarter was 6.9% growth. The bond market told a completely different story. The 1-year Chinese government yield fell from 3.1% to 2.5% in 11 weeks. Capital fled into safe instruments. Silver imports that year spiked 23% above the prior year average. The official data said fine. The scoreboard said crisis. Column 2, 2019 to 2020. Pre-COVID, China was already slowing. Real estate developers were beginning to show stress. The 1-year yield was declining. Silver imports were elevated. Then COVID hit, and the official data became meaningless for comparison purposes. But the pattern was already in place before the first case was reported. The bond market knew. The silver flow knew. The GDP number did not. Column 3, 2022 to 2023. The real estate bust went from hidden to visible. Evergrande defaulted. The People's Bank of China warned Chinese banks in 2023 do not buy long-duration government bonds because when the system recovers, rates will rise and you will be slaughtered. The banks said nothing. They bought more bonds. By late 2024, the 10-year Chinese yield had plunged to 1.6%, not because rates were being cut to stimulate, because there was nowhere else for the money to go. The real economy was not accepting capital. Banks were sitting on foreclosed properties they could not sell at auction. Profitability was disappearing. Many of the largest Chinese banks are now reported to be cash flow negative, burning capital to maintain properties they cannot liquidate. And yet they kept buying bonds. That is not stimulus. That is fear. Column 4, April 2026. The one-year Chinese government bond yield is now at 1.15%. That is the lowest it has been since January 2025 at the tail end of the previous flush. The 10-year is below 1.8%, the lowest in several months. But here is the critical part of this column. The bull steepening, meaning rates falling more aggressively at the short end than the long end, has continued through April despite the Iran ceasefire and the re-risking that drove U.S. equity markets to near all-time highs. Every other risk asset responded to the ceasefire with euphoria. The Chinese bond market did not move. It kept bull steepening, as if nothing had changed. Because as far as the Chinese bond market is concerned, nothing has changed. The scoreboard is still reading the same way it has been reading since the fall of last year. Now, here is why this data is not being discussed in the places you normally look for financial information. The official GDP number for China in the first quarter of 2026 beat expectations. The financial press ran that headline. What they did not run was the fine print. Retail sales, the measure of what Chinese consumers are actually spending, were revised dramatically last month. The data had shown a sharp decline. Then the Chinese government, 1 month before the National Party Congress, revised those numbers and showed retail sales as relatively flat. Then the Party Congress ended, and this month the retail sales data went right back to showing the sharp decline. The revision disappeared. The weakness returned. That is not a data anomaly. That is a 1-month cosmetic fix that tells you exactly how bad the underlying number actually is. And unemployment, which in March, a month that follows the Spring Festival holiday and should historically show unemployment falling, actually ticked higher. It went up during the holiday, then went up again in March, 2 consecutive moves in the wrong direction during the season that should show improvement.
Now, you might ask, if this data is this clear, why does nobody talk about it? Here is the structural reason. Less than 4% of professional fund managers in the United States actively track the Chinese bond yield curve as a leading indicator. The institutional framing around China is almost entirely equity-focused. Chinese stocks, Chinese ADRs, the MSCI China Index. Bond market signals from China are treated as a domestic Chinese issue, not a globally synchronized signal. But here is what the data actually shows. China is the world's largest exporter. Every recession signal in the Chinese system is a forward-looking indicator for the rest of the global economy, because Chinese factory output does not slow until global demand slows first. When the Chinese bond market bull steepens, it is not saying something is wrong with China in isolation. It is saying global consumers are pulling back, global financial conditions are tightening. And China, which sees that consumer pullback in its order books before anyone else does, is pricing it into the bond market months before it shows up in any Western economic data release. Your financial advisor will not explain the Chinese yield curve to you. Your brokerage platform does not show it. The mainstream financial media does not cover it, because covering it requires explaining that the U.S. stock market at all-time highs and the Chinese bond market bull steepening at the same time are not contradictions. They are 2 parts of the same signal. Front-running and re-risking on one side, defensive positioning and capital safety on the other. Now here is what the demand destruction scoreboard says to do with this information in April 2026. The silver import figure is the action signal, not the commentary. 836 tons versus a 306-ton seasonal average is a 173% surge above normal. Chinese retail investors are not buying silver because they read a macro report. They are buying silver because they can sense what the bond market is confirming, that the banking system is under stress, that real estate losses are still being absorbed, that employment is softening, and that the one place outside government bonds where savings are genuinely safe and liquid is physical precious metals. This is not an inflation narrative. This is a banking stress narrative, and the difference matters enormously for how you position.
3 thresholds to watch. Threshold 1, the DXY dollar index below 97. The dollar has already broken below its 200-day moving average. It peaked near 106 in late March and has been retreating.
When the DXY falls and holds below 97, that is the confirmation that dollar-denominated assets are losing their safe haven premium and that capital is rotating into silver, gold, and other hard assets at the institutional level, not just the retail level. Threshold 2. The 10-year U.S. Treasury yield below 3.5%. When the nominal yield on the 10-year falls below 3.5%, real yields compress, the opportunity cost of holding physical silver collapses, and the performance gap between silver and treasuries closes violently to the upside for silver. The 10-year peaked at 4.44% on March 27th. It was already retreating toward 3.85% by mid-April. Threshold 3. The gold-to-silver ratio compression below 75. Right now, the ratio sits above 80. The long-term average is 60. Every time the ratio has been above 80 and then compressed back towards 60, 1979, 2003, 2011, 2020, silver has outperformed gold by a factor of 2 to 4 in percentage terms during the compression phase. At a ratio above 80, silver is historically cheap relative to gold on a multi-decade basis. For instruments, the iShares Silver Trust, ticker SLV, is the primary liquid vehicle for silver exposure through an ETF that tracks the spot price directly. The volume profile on SLV over the last 6 months shows a major support level around $69.35. Buyers have been stepping in consistently at that level. The 50-day and 100-day moving averages are both holding. If SLV breaks the resistance above the current range, the next volume cluster sits near $80, and above that, the path toward 100 is largely open air with declining volume resistance. For leveraged exposure with higher beta, the Global X Silver Miners ETF, ticker SIL, captures the operating leverage of silver mining companies. When silver moves up 25%, miners, whose extraction costs are fixed, see profit margin expansion that historically produces 2 to 3 times the percentage gain of the metal itself. Perth Mint Physical Gold, ticker AAAU, holds metal in an Australian government vault outside the U.S. banking system for those who want zero domestic counterparty exposure. And for the macro hedge, SHV, the iShares Short Treasury Bond ETF, is the Loomis equivalent cash position during the compression phase when long-duration bonds face repricing risk. The demand destruction scoreboard I showed you at the start of this video has 4 completed columns: 2015, 2019, 2022, April 2026. In every prior column, the gap between official economic data and real market signals closed, not gradually, not smoothly, but in a recognition event that moved silver sharply. The retail investors buying 836 tons of silver in China in March 2026 are not guessing. They are sitting inside the Chinese economy, watching their employment market soften, watching their banking system buy government bonds that yield 1.15% because there is nowhere else safe to put the money, watching their real estate market continue to bleed value, and watching their government revise retail sales data 1 month before a political congress and then quietly revise it back the month after. They are not reading this in a report, they are living it. And they are moving into silver. Most people will never see this data. The GDP headline says fine, the stock market says euphoria, the bond market in China is saying something completely different, and 836 tons of silver says the people closest to the situation already know which signal to trust. This is BAN. Now you see it.